Thanks for being here tonight. My name is Lee Bratch. I'm the president of the Texas Blockchain Council. We're an industry association making Texas a leader in blockchain innovation. We cover anything from Bitcoin mining, crypto, DeFi, to enterprise blockchain, tokenization of real estate, all those kinds of things. Tonight we're talking about real estate and crypto. We're talking about tokenization. We've got an awesome panel who will be filtering to the front as I speak. I see a few of them. Oh, there they are over here. Before we start the panel discussion, I will say a few housekeeping notes. The bar is open, but if you would just move forward and instead of congregating at the bar, because the floor is concrete and it echoes, and there'll be a challenge for you guys to hear if there's a bunch of people in the back talking. So move forward and grab a seat as you're able. The Texas Blockchain Council does these events monthly in Houston, Austin, Dallas. There's actually an event going on tonight simultaneously in Houston and the Woodlands. We'll be starting at Fort Worth soon. So if you maybe come from out of town, we do these events all over the state. As Ryan said, we are working on the policy side, but we also have member companies, both individual members who are not affiliated with the company and corporate members who are part of our industry association. Think of it as like a chamber of commerce. And we help build their influence, help them find their next investor, their next client, or their next employee. We are a nonprofit industry association, so we don't really have a dog in the fight as far as all that goes. The last thing I want to do is just thank our host this evening, Tim Tu back there, and Gam, who runs the drawing board. The drawing board has been an incredible host for the TBC. Our offices are here. We do this, our Dallas-based event here, and I don't know, there's a bunch of crypto people who are now officing here too, so I just heard there was six additional crypto folks who now office here the last couple months. That's great. We're trying to make this facility sort of a hub for that kind of innovation. So without further ado, let me introduce, I'm going to have the panelists introduce themselves. So we have Sohail Hassan, we have Brian Scheffler, and Yale Hamrick, on the far right. They're going to introduce themselves, then we're going to dive into a conversation about blockchain, crypto, and tokenized real estate. So Sohail, why don't you kick us off?
So as I mentioned, or as Lee may have alluded to, my name, again, is Sohail Hassan. I am a principal and managing partner at a firm called Markets-Based Capital. We are a private equity real estate development firm based out of Houston, Texas, and we focus primarily on ground-up developments and value-add acquisitions of multifamily properties. We currently have around approximately $480 million of assets under management. And we are going through the process right now of tokenizing our very first asset, which is located right here in Dallas. And so we're going through the process of that right now, and I'm excited to share with you guys kind of what we've learned along the way, and hopefully you'll come away with it learning a little bit more about how blockchain and real estate can work together. Thank you.
That's great. My name is Brian Scheffler. My background is software development. I co-founded a software as a service business about 18 years ago, and just last year we had a successful exit of that business. I've been investing in real estate for about 7 years, both as a LP and GP on multifamily. And so I've been looking at what to do next on the software side and focusing on blockchain and real estate and how they work together and how they can solve a lot of the problems that exist today. And yes, thank you for having us up here. I've already learned a lot just being here tonight, and hopefully I'll learn a lot more on the panel, hearing everybody talk.
Can you hear me? Can you hear me, guys? No? Not really? No? Can you hear me now? Can you hear me now? All right, so my name is Yale Hamrick. Lee, thanks for having me. Ryan, also thanks for inviting me. I've been a single-family investor, single-family real estate investor for the last decade. I got into real estate after I was in the Navy. I've focused on the Burr method of acquiring rental properties. I have a multi-million-dollar rental portfolio, mainly here in Tarrant County, Texas. I don't usually speak at these things in real estate, but I feel like real estate and Bitcoin blockchain specifically, there's a lot of parallels, and I've been in the Bitcoin space for a handful of years now. So I feel like by no means do I feel like I'm an expert at all in blockchain, but I feel that there's a lot of similarities, and I feel that there's a big disconnect between the crypto space and the real estate space. And I feel that when there's more knowledge that happens, people see that there's a lot of similarities, and there's a dire need for blockchain technology in real estate. So thanks for having me, and looking forward to speaking with these guys up here and kind of having a conversation. But I'm really want to talk to everybody in this room, and see, because I really feel like this stuff moves forward with little groups like this, and we all talk amongst it, and we come up with ideas, and then we take massive action, and that's how this happens. So thanks for having me, and hopefully we can accomplish that tonight. So, yeah.
So, could you share a little bit, I know you talked about the similarities between Bitcoin and real estate. Talk about those things as an asset class, and why do you want to mention those things in the same conversation?
Yeah, so.
Sorry.
All right.
I'm an audio tech, I know,
all right.
I clearly know what I'm doing.
Okay, we good? Yeah, so like as an asset class, there is volatility in Bitcoin, and there's not as much volatility in real estate. The thing that Bitcoin, in my opinion, is going to try to be is almost operates as like a bond, where you're going to be able to, lend against your Bitcoin holdings over time. As the volatility, if Bitcoin goes to say $1 million, $2 million a coin, the volatility will cease, and it will start to act more like real estate. Now is a time where most people can afford to continue to buy Bitcoin. The similarities of real estate, right now I use my rental properties and I take loans against that to take my cash and then go purchase things like Bitcoin. Later on in the future, it's probably going to be Bitcoin that I use, because the holdings that I have in Bitcoin will outweigh my real estate holdings. I also think, if we're going to talk about Bitcoin and real estate, me and Lee just talked about this. I think that over like the next 10 to 20 years, over the last 10 years, I thought that real estate was the asset class to be in, and I holded my real estate, and I sold some, and I kept some, and I sold my real estate. But over that 10-year period, I kept my real estate. Now is the time to be doing that with Bitcoin. I think that you hold the Bitcoin over a period of time. You continuously invest into the market. A lot of similarities to how I built my rental portfolio, because I continuously just invested into that market. I continuously held properties, sold some, and I think that there are drastically similarities to holding a Bitcoin position. Are we taking questions, please? I'm not sure.
Just a real brief question.
Sure.
When you say Bitcoin, do you mean the actual Bitcoin or just cryptocurrency?
Oh, no.
in general?
Yeah, great question. And I think that needs to be, I mean Bitcoin. So I wouldn't call myself a Bitcoin maximalist, but I've been in the space. I don't think all cryptocurrencies should be looked at equally. I don't think all blockchains should be looked at equally. I think that the Bitcoin blockchain is very, it's immutable. And other blockchains say they are, but we know that over the course of the last 12, 13 years that Bitcoin is. So I'm talking specifically about Bitcoin, and when that asset gets to a price where it acts similar to real estate. One thing I do, if we're talking about that real quick, I think that over the next 10 to 20 years, possibly, if Bitcoin does go to $1 million to $2 million a coin, I think that it may, if Bitcoin does fix this, you hear that saying a lot to some of the crypto people, I think that it could fix the affordability in single-family homes. I feel that it could bring down the price of single-family homes. If Bitcoin is an asset that's worth $1 million to $2 million a coin, your regular investor is probably just better off buying Bitcoin than trying to get into single family, taking all that risk. There's an education, there's management, and I really feel that the prices nowadays are going up because of investment. A lot of investors are looking at single family as a way, but I think Sohail will talk about tokenization and stuff like that here. But yeah, to me, those are the similarities of Bitcoin and real estate. And,
Sure, and I think it's important, thank you for that, Yale. I think it's important to understand the distinction between the asset classes, okay? So when you're talking about Bitcoin, you're talking about cryptocurrency, right? You're using that to pay for something. Then you have NFT, which is non-fungible tokens. I think somebody had asked me earlier a little bit about that. Then what we're talking about specifically is what's called digital security tokens, right? And that's why taking ownership in real estate and being able to tokenize that. So it's important to not combine the two, because a lot of people have a negative connotation when it comes to Bitcoin or Ethereum, particularly because of the volatility that's inherently there, right? But when we're talking about it, we're looking at the technology that powers that cryptocurrency, which is called blockchain. And how we can apply that blockchain technology to a variety of different industries is what we're interested in. Particularly tonight, of course, is how we can apply it to real estate. So I think that's important to make that distinction.
And also to note that Bitcoin is not a security, as listed at the SEC is declared that Bitcoin and Ethereum are not securities. All of the things that we're talking about in real estate, when you tokenize it, it is a security. And so let's talk a little tokenization. So run us through the high level. What are the two main benefits that you realize when you tokenize that?
Sure. I'd love to. And I think before I do that, let me preface the conversation by kind of giving you guys a little bit of history on kind of how we ended up to where we're at today. So when we originally started this firm, I was working with two other partners of mine, and they have been working in the real estate space since 2011, and they had made a variety of different acquisitions into multifamily, office, and retail assets. But when I joined the company, and we met for dinner the very first night, the conversation was how we can use technology to really disrupt this industry. And of course, at that time, blockchain, or particularly the application of blockchain to real estate, was still in its infancy, right? And so we decided to take a traditional approach of investing in, the traditional way into real estate assets and building up our AUM, our assets under management, with the idea that one day we would then go and tokenize it. So over the last year and a half, I would say that we've really spent a considerable time, money, and resources onto a strategic plan of how we can tokenize an asset. And there's been about 10 different people in our office that have touched this, as I mentioned, over the last year and a half. And what we wanted to do is take one single asset and tokenize that first to really understand the implications of it, to understand the unknowns, right? But once we can use that as a sort of case study, that we can then take the remaining portion of our assets under management and tokenize that as well. Not to mention there's partners of ours. For example, I was mentioning this back there, that we have a partner of ours in Houston that owns 11,000 apartment complexes, right? He has over $1 billion of assets, and he is the only owner in these assets. But it's funny because every time he's going to acquire a new asset, he doesn't go and syndicate capital. He doesn't go and raise money. He refinances an asset and uses those refinance proceeds to be able to go and invest in real estate. Now for him, imagine taking his $1 billion portfolio and tokenizing it. We're essentially creating, so much liquidity for him that he can then use that liquidity to go and, of course, acquire other assets. So there's, I fundamentally believe that we're just in the beginning stages of this. And again, we, for better or worse, have kind of been thrown into the spotlight simply because we're the first, sponsor or company, a private equity firm that's doing this in real estate. And as you mentioned, we're doing this with a property here in Dallas. So it's a 250-unit property. The construction cost is approximately $50 million. It was appraised at a stabilized value of $66 million. And so that's it, right? And the traditional way of you investing in real estate with our company, you would basically sign a subscription agreement or a PPM, a private placement memorandum, and our minimum investment amount is $50,000. So you would be signing a agreement with us saying that you're buying 50,000 units of this LLC, and again, this LLC owns the underlying asset. Now, in this traditional way, you're locked into this partnership, right? The only way you're getting money back is if there's a liquidity event. And that liquidity event will happen in a refinancing scenario or if we sell the asset. All right? So this is the traditional method right now. And if you invest with us, we offer you an 8% preferred return typically on our projects. So if you invested $100,000 with us, you're earning $8,000 per year on that investment. And we go through and construct the project, we stabilize it, and then again, we go and refinance it. Now, in this same tokenization aspect, it's the same exact scenario. But in this scenario, instead of me giving you a piece of paper that says you own 100,000 shares of this LLC, in this scenario, I'm issuing you 100,000 tokens, okay? Now, these tokens are what we use what is known as a stable coin. In particular, we're using something called Circle coin, right? And basically, it tethers itself to a fiat currency. Obviously, us being here in Texas, we're using the US dollar. So every one token that I'm giving you equals $1 US. Now, because it's attached to that stable coin, there's no fluctuation or volatility that you might see in Bitcoin or Ethereum. So that is removed from the entire process. And let's be honest, that's kind of the biggest fear that people have by investing in these things, is that they have no idea what's going on. So immediately that's eliminated. Now, I give you those tokens, and you basically have a digital wallet similar to a Charles Schwab account. And in that account, you now have 100,000 tokens that you essentially keep in your account. And after 12 months, there's a vesting period, right, according to the SEC rules. It's called Rule 144, Section 144, where it basically says that there's a limited vesting period that's required. So in this scenario, it's a 12-month vesting period. So after 12 months, you have the ability to take all 100,000 tokens or fractionalize it and take 25,000 of those tokens and put them onto a secondary market, which is basically a decentralized stock exchange where people can offer you shares to buy those tokens from you. Okay? Now, what this does is it addresses, and to your point, Lee, this addresses kind of the two biggest drawbacks to investing in real estate. First and foremost is the inherent lack of liquidity, right? Again, you're locked into the partnership with us. The second is the high ticket cost. Again, to invest with us, it's a minimum of $50,000. And 93% of retail investors in the U.S. currently do not have $50,000 that they can put into our assets. So by allowing fractionalized ownership into real estate, you're now breaking it down. So I can take 100,000 of my tokens, and I can take 25,000 of those and put them onto this platform. And somebody from Japan, from Korea, from the UK, and I'm mentioning these countries because people literally from those countries have reached out to us saying that they want to invest in U.S. real estate, but they don't have a method or means to do so. So now we're essentially providing that for them. And one more point before I hand it over to my fellow panelists here, but the value that we're attributing to here, just kind of break it down for you in simple terms. Again, we're building this project for $50 million. The project is going to be worth one day at a stabilized value. Once we have occupancy, it's going to be worth $66 million. So all of those investors who are buying in at the token share price, they're buying in at that $50 million valuation. But we know that the project is going to be worth closer to the $66 million evaluation. So that token you hold with us is going to increase in value. Now imagine this, as we go through the construction process and we achieve certain milestones, the cost of your tokens are increasing, right? The value of your tokens are increasing. So after a single year, let's say we're halfway through the project, and you need some capital, you could easily go onto the secondary market and be able to sell those tokens at it maybe double the value of probably what you bought it for. Again, but it gives you more options, right? And ultimately, as I mentioned, it's kind of addressing those two biggest drawbacks to what is typically known with investing in real estate. And I don't know if we're open for questions right now, but let me
I've got
questions.
So that's very, very fascinating. I'm going to ask a few questions first.
Sure.
And it ties in with syndication. So the stable coin is pegged to the dollar. It can be done many different ways. I'm not familiar with Circle. We've talked about a few different ones. There are some that are backed by USD directly, the dollar. So as you buy, like Gemini, they actually take your dollar and they put it in a bank account, and it is somewhat FDIC insured.
Yeah, so Circle is USDC. So
It is.
You're familiar with Circle. It's just a different name.
Okay,
USDC.
great.
Yeah.
Okay. This is all software, which is just absolutely fascinating, because with software you can do almost endless number of things. The tokens that are being described are digital, and they are controlled by smart contracts. Smart contracts are nothing more than programs. And so these programs have rules and algorithms and decision trees and all kinds of things that will help the token deliver value. One of the things is, how do you distribute to your LPs? How do you distribute money? When you have tokens, you distribute to the token. So you track the tokens, you don't have to track the individuals anymore who are in your deals as a syndicator.
Yes.
And so it eliminates a lot of friction. So where in the past syndicators liked having fewer number of investors, now it doesn't matter. Whether there's 5 or 500, their amount of work is exactly the same. So I'd like to dive a little bit into the tax part of this. And we, those of us who are GPs or LPs, we get K1s at the end of the year. How does this change when you can be in and out of tokens throughout a year? Do you get a K1 if you're just a small, like if you owned it for 6 months? How does that work?
That's exactly right. So there's a couple of different vendors that we use. And again, we spent a considerable time and amount of money to really do due diligence, because we wanted to make sure what we're investing in obviously was credible resources. So we hired an attorney that specializes in blockchain law. He's based out of Philadelphia. Fantastic attorney. We hired a company called DigiShares. DigiShares essentially helps us with the actual tokenization aspect. And they also, and we can get into this a little bit later if we want to take a little deeper dive into the weeds of this, but they're also helping us on the investor portal aspect as well. And the investor portal, again, imagine that right now we're using an investor portal like CrowdStreet or Juniper Square that's very favored towards real estate investments. Now we need something that also is reflecting tokenization and blockchain. So that's kind of a whole other story as well. In addition to that, we use T0, which is the secondary marketplace. There, where we're listing essentially these tokens, then you have the ability to trade them. T0 is, again, I think I'd mentioned these guys back there. The reason why we went with them is because they have about 90% of the current market share. They were founded by the Overstock.com guys, and so they're very well funded, of course. And the most famous real estate asset, which is tokenized, the very first one, is the St. Regis Hotel in Aspen, Colorado. They kind of did the T0. T0 had tokenized their asset, so that's one of the reasons why we worked with them. But the other one to note is a company called CompuShare, and this kind of comes back to your question here, Brian. And CompuShare manages our cap table, because as you said, on a single day there could be millions of people theoretically that could buy and share your tokens. And so all of that has to be managed. And so there is a specific company that manages that, again, CompuShares, and essentially it's all done on the blockchain. And all of this is managed from them, and it's put up into a nice, tidy little package, and it's sent to our CPA, who's then able to do the taxes on it. And the taxes are treated just like a normal LP investor is, in that you would receive a K1 for the period of time that you have that investment. Now, to your point earlier, and kind of just simplifying it again, these smart contracts are just like vending machines, okay? You put your money into a vending machine, you select a number, and it spits out something, right? So imagine taking our PPM or our subscription agreement and integrating that into a smart contract. So it has all the same actions the same structure that we provide to our investors. An 8% preferred return. They get their money first, plus any of that accrued preferred return. Then it goes to a 70-30 split, 70% going to the investors, 30% now coming to us, the sponsors. And that's how we make our money. Now, all of those same exact terms are integrated into a smart contract, and now it's executed by and backed by the blockchain. So
That's fascinating. The thing I'd like to point out too is the options that you have as a syndicator or a sponsor of a deal using these smart contracts and tokens are beyond what you can do today. For instance, you could actually program these tokens So you get a small residual every time they change hands.
Yeah.
And that way, you're continuously benefiting, and it doesn't have to be a lot. It can be 0.5% or something to that effect. And it's a way for the original issuer of the token to continuously get some small amount of revenue. And that's a very small number for the LP to have to pay, and they gladly, certainly would pay that.
Sure. No, and I mean, we're just at the tip of the iceberg in terms of the efficiencies that blockchain can allow to our industry. And from everything from, even you're talking about earlier, distributions. So every time we do distributions right now, we have to collect all of the ACH or wiring information. We no longer do checks in the mail. Typically when you're investing in real estate, it's about creating passive forms of income. So in the back of the day, they called it mailbox money because you would literally physically receive a check in the mail. But of course, nowadays we do everything through ACH, electronic distribution. So it is a headache, and there's fees involved, and there's a whole process. Now imagine how much more efficient that could be by the distribution of tokens, right? And so that's just one aspect of it. I mean, there's a number of different elements that you can create efficiencies from in this industry. And another one of those, of course, is title. And I think Yale and Lee can have some really good feedback on how the title industry can be disrupted by the use of blockchain. Maybe you can go into that.
Yeah,
first.
I actually like to comment on the tokenization aspect of it to single family. A lot of people have heard of the hedge funds that are buying single family real estate right now, tons of them. One of the things that I see, why would hedge funds buy single family real estate? It doesn't cash flow the best. It's a lot of work to manage. One of the things me and Brian have talked about that I really do believe, hedge funds may be ahead of the game in the tokenization. They may feel that because the tokenization of real estate starts with owning the asset first, right? You have to own the asset first to be able to tokenize it. And once you have the assets owned, I really feel that the hedge funds are not necessarily making a real estate play over the next 5 to 10 years. They're making a tokenization play. And they are on the forefront of buying up the assets to be able to tokenize them, to do the offerings, just like Sohail had said. And I really feel that, that could be why these hedge funds are into the single family real estate sector right now. So, that's some of my thoughts on the tokenization side.
Yeah.
So one additional thing, we talked about liquidity, right? So it offered the ability for LPs to cash out if they wanted to. It also offers the ability to use it as collateral, so they don't have to cash out. They could actually go to a trading platform, take a loan out, and use that token as collateral. You'll value your property, so the token would get value. It would be known out in the industry, on these trading platforms what that value is, and you would use that as collateral, just like in the real world. But
It
digital,
won't take 45
fast,
days to do.
It won't
take
right.
45 days to get a real estate
It's
loan and all the friction.
It's 24/7,
Yeah.
right? It's all software running this stuff. There's nobody checking documents and saying, yes, he's approved, because you have the token. It's has this value. That's all that they care about.
Yeah, I really think that the tokenization, it really lowers the barrier to anybody to invest in real estate. Right now, it either you have a lot of money or you have a lot of education. Somebody that has the money that you can be able to purchase real estate on some kind of scale. I think when you tokenize it, the collateral's there. You can literally interchange it out. It makes it liquid, and that brings the barrier down here where, maybe in 10 or 20 years that everybody's a real estate investor, and instead of owning property, I own tokens. I would love to own tokens instead of real estate right now because, real estate there's a lot of moving parts. Getting into the title aspect, just having to go through the title process of purchasing a property is a pain in the butt sometimes. There's a lot of human error. Lee, do you want to go into the title stuff right now? We can go into that. So, there's a lot of human error when dealing with the title process of just getting it, from purchasing to recording the title. Right now, a lot of the software doesn't speak to one another. There's counties that have deed records, and Dallas County is different with Tarrant County. So, what blockchain will do is it will make those softwares communicate with one another. So you don't have these silos that, this different data that different people are pulling from. You have the blockchain that everything is there and the friction goes away. You know, I'll give you an example. Yeah, I've been doing this for 10 years, and I wish I could say I've had less properties, but I've had a lot of properties that sometimes I fix a property up, I go to sell it, or I go to refinance, and somebody at the title company that I closed with did not record the deed, okay? They didn't record the deed. I don't even own the house in the eyes of the county. That would never happen if you are running the software on blockchain, because I could sell my house to Brian right now and we could sign a contract. We know it's sold, he knows it's sold, but the county doesn't know it's sold. In the eyes of the county, it needs to be recorded. So we are in a paper system, right? With blockchain, if I sell it to him, it's immediate, it's immutable, it can't be changed. Everybody knows now because it's on a public ledger that is announced to everybody. So if I go to and then everything can be built on top of that layer, and I think that it takes the friction out of, it definitely takes the human liability and error out of the title process when dealing with real estate, because you have so many different people that are involved, and if everybody can work on that blockchain, they can build their software on top of that, and everything can communicate with one another. And it really, instead of me calling this tax office and this attorney has to work with this title company that they've never worked with before, and this county does the little things different, and this insurance company doesn't know what, has never worked with this person, it all connects interchangeable in the blockchain. And I feel that this is something that real estate definitely needs, but I don't know how fast it works, because it's a government level that it has to start from the bottom up, I feel like. I feel like if we want to take title transfers and deed records onto the blockchain, it has to happen with the people who own the real estate. And I feel like that is a long process. I feel that I love to sit here and say that, hey, I think this is happening 5 years. And I do think this technology is happening now. But I really do feel like we're in 1996, and it happens over the next 20 years. With real estate and that fully onto the blockchain. I think Lee can kind of talk about some of the steps that we would have to take for blockchain to kind of take over for title.
Sure.
Yeah.
So in a former life, I was a political science professor, and my research area was blockchain-based land registries. So looking at how the county recorder's office could integrate this kind of technology. There's 254 counties in Texas. They all do this differently.
All of them.
And Yale and I are in agreement on this. It's going to take years for this transition to take place, and title companies are not necessarily going away, although I think some of them are.
Yeah.
Just like banks are not going away, although probably some of them are. It's a natural free market competition. It would happen with or without blockchain, or with or without Bitcoin and crypto, but I think those things accelerate that process for the companies that adopt this technology and move forward. It's more of a political challenge than a technology challenge. You've got to get a county clerk to want to train their employees on this new software. There's just a lot of obstacles before we get there, but I think it's certainly coming. One of the big obstacles, which is also political, is the deregulation of title. So in Texas, as you all know, title is highly regulated. It's regulated on formula. There's not competition on price, there's competition on service. So once the legislature deregulates title, you will not only have the incentive to provide better services for a county clerk to provide better services in the county recorder's office for their constituents, but you'll also have that price piece. And I think that's way more important. The reason why we're up here talking about tokenization is because LPs are incentivized with liquidity, greater liquidity access, all these different things that this incentivization pushes them towards. You really need that like monetary incentive for title to get deregulated, and that's kind of the bottom line. I think before we see greater movement on this, you got to see some things on the political front happen, on the regulatory front. But the good news is we don't need title to get deregulated before we do all the other things that we've been talking about, tokenization and stuff. So let's perhaps pivot a little bit back into a deeper conversation about tokenization. Sure. So we've done some high-level stuff. Let's get in the weeds a little bit about tokenization. I don't know who wants to jump in, but Sohail, Brian,
Sohail would go there.
Yeah.
Sure. Or Brian. Yeah.
Go ahead.
Yeah, happy to.
Sohail.
So what I think is one of the most interesting things is how people are using their existing portfolio. So for example, there's a gentleman named Jim McKinney. He owns a company called McKinney Properties. And funny enough, his great-grandfather founded this firm back in 1860, and he's now inherited it. And most of the investments that they have done have gone to 30, 40 years. And the people who made those investments, now their heirs have taken over, and they're receiving the benefits. And they've received like a 10x return on their money. But the heirs who now own these assets, they no longer want to be involved in these real estate projects, so they want out. So when they want out, right now, they would go to a secondary marketplace, which one doesn't really exist for real estate, or they would go to somebody who would say, okay, I'll offer you 50% off of what it's worth, right?
Is that the illiquidity discount? Could we call
There
that
you
the
go,
illiquidity discount?
discount. And then they come to him, and he's like, look, I can offer you 30% off of what it's worth, and he's buying them back at 70%. But even that's not fair. And again, these are like friends and family and people that have really high net worth. And so now they're looking at tokenization, and then basically tokenizing these existing assets so they can give the ability for their investors who want out to get out, and those who want to stay in can stay in. And again, they're already past the 1-year rule. So here, I'm talking about a construction project where that 1 year is important to us. To them, of course, it's been 30, 40 years. So it's just kind of showing you a sliver of what is to come, right? And there's just so many ways that it's impacted. We went the traditional route of investing normally into real estate and then kind of going back and tokenizing it. There's some people out there that are now going into and raising capital through the tokenization aspect. But it's interesting to see somebody who, again, is coming from a completely different use case in that they have a ton of people who've invested with them historically for hundreds of years apparently, and now they want to convert them into tokenization. So it's very interesting.
And it's important to note that it's not just real estate. It's any private business can be tokenized. Anything that has value that's locked up with seemingly no way to release that liquidity. Our business that we started was a perfect example of this. For 18 years, we built the business, and we had to wait till the end to sell to private equity to realize gain. It would have been nice to possibly, over the years, issue tokens. It's almost like a private stock offering, but in a public forum. And once you take something that's private and you make it public, the value shoots up. It's immediate because you have a much wider audience, and it's beneficial to everyone. So having debt, right? We talk about real estate, the asset. There's also, in the capital stack, there's debt. Debt can be tokenized as well. It effectively, the way that works is when you do take out that mortgage, whether it's for a house or an apartment, the broker or the agent behind the scenes, they're collecting all these things together, and then they sell them to larger entities. And what was that Michael Burry movie about the
Big Short?
The Big Short, yeah. So if you remember, in that movie, he was talking about how all this stuff in the collateralized mortgage fund was just crap, right? And his boss said, "How do you know?" Right? He said he read through every one of them.
That's
right?
the blockchain.
Now, that is the blockchain. That's perfect. It's
Yeah.
a perfect example of the blockchain. He wouldn't have had to read every one. It would have been available immediately for analysis, real time, 24/7.
For everybody.
Right.
Yeah.
Love it.
So, when you tokenize something,
Sure.
what are you tokenizing? Are you tokenizing the deed, the title, a limited partnership? What are you buying?
No, in some of those cases, you could be doing all of those. In our particular case, you're buying limited partnership shares. So again, out of a $50 million project, right, we go and we get debt, right? 75% of those project costs come from debt, right? There's a 25% that's left over. We, the owners of market-based capital, will put 5 to 10% from our pockets. The remaining 15 to 20% that's left over, we go and we raise from outside investors, right? At a minimum investment of $50,000. So now you've made that investment, and again, In this case, you're tokenizing those shares of that LLC, right? And you're buying those shares, and you're essentially owning those tokens. The real estate. So
Yeah.
this is, again, you're investing in a tangible asset. This is not a stock where there's volatility. You're investing in actual, materials that are there, people that are living there. They're paying their rents every month, right? That's a operation, that's a business. We have a net operating income. We throw off cash out of each of these assets on a yearly basis that goes off to all of the investors.
It's a syndication, just digital form.
That's
Yeah,
exactly.
That's all it is.
That's why it starts with owning the asset first. So when you own in a limited partnership, like you had said, it's the LLC is specifically created to hold the real estate. And when you own the shares in the LLC, you do own, because the LLC specifically is created to own the real estate.
What if you did it without an LLC wrapper, and then could you do a 1031?
I don't think this affects any of the real estate tax laws or
Yeah.
rules. It is purely a syndication. I don't see how that, the issues you would have is if you want to sell the property as a GP, some of the features of blockchain and everything we've been talking about, the tokenization, is there's ways to vote, right? Because at any one time, every owner of a token, and you can have a vote. The GP can vote, or can initiate a vote, say we've had an offer for somebody to purchase the property at this amount. Please indicate whether you're for it or against it. If they're for it or against it, then somebody would buy their token, I would assume. Or maybe the GP interest. I don't. You might.
Yes. So
There
hell,
you go. That's the correct answer.
Eliminate the tokenization piece and have the purchaser buy out all the tokens and then eliminate that element of the deal, or the purchaser could basically stand up and operate the tokenized property under the same structure.
Makes sense?
Yeah, except,
Yeah, we got to open up for questions. We are opening up for questions.
yeah, I'm fine with it.
you've got LPs who are managing your entity, and that blows up your LP.
So, I would just say that we're not going to digitize. We won't digitize the GP shares or that just the LP.
Digitized is the GP share.
No, that's not what the tokens are LP shares.
Then there can't be any voting.
Sure there can. Just like today, a syndication you're involved in today, you have certain rights based on the PPM. It's all about the rules that are set in the PPM.
That's right.
If you buy shares that have no voting rights, you don't get voting rights.
Which is what our setup as. And to your point, the lender is actually the one who's driving that, because the lender is not going to give a loan to someone
Right.
that can trade, right? So they're going to be the ones that provide the limitations there. And in this case, again, it is only the limited partnership shares. And we do not have those rights where they have voting rights. They are just limited partners. And in our case, we're the GP, and therefore being the general partner, you're the controlling entity. And I heard someone here ask what a 1031 exchange was. Basically, when you sell real estate, there's a capital gains event where you have to pay taxes on that. But because of the tax laws, currently the way they exist, you are allowed to do what is known as a 1031, where you can take those funds and then deploy them into another real estate investment and therefore defer the capital gains taxes that's being paid. Correct. It is a fungible. You got it. Fungible. Yeah.
So the question is, are we talking permission or permissionless blockchains, and are they fungible and non-fungible tokens? And I think it can be both and both. That's just.
Yeah. Ours is fungible, and it is closed. So it's only for our for us. Yes, correct.
But you're not going to issue more tokens.
Correct.
Right, you're just going to be able to split up the ones you have.
That's
what
exactly
you-
right. And we are governed by the PPM
Mhm.
in the amount of tokens that we can distribute, which is the amount of total equity that we can raise on the project.
And I heard you say earlier that SEC sets a minimum right now on use for investors.
A vesting period, correct. 12 months. No, not the amount. The amount has nothing to do with it. It's just the amount of time.
Okay, so they can invest any amount.
Correct.
I'll set the amount.
Yeah, we have a minimum investment of 50,000 set by us.
You can make that 1,000.
Of course.
Y'all decide.
Yes, correct. But it would never be 1,000, but yes.
But I think eventually, maybe not.
Through tokenization.
Yeah. Well, we have a lot of questions. Right there.
Thank you. So about tokenization, the securitized token. So you have these tokens, you can't just go to Walmart and get groceries with them, right?
No.
You can't go to a brokerage, broker exchange. What kind of commission or fees are they looking at there?
I mean, it depends. Like, you know, again, you're doing this in an app. At the click of a button, you can convert, you know, your tokens into US dollar. I don't know what the fees are that's associated with it. It's a great question that I don't think has ever come up yet. But if you can write that down, Josh, we'll find out.
Pass on to the GP. The token holder is not really accruing a lot of the fees from the ATS or broker dealer. ATS being the
That's correct. But he's asking converting to USD, right? Is that what your question was? Yes. Yes. Yeah, it is. Okay, yeah. Oh, yeah, there's gas fees associated with that, but, you know, you're right. That itself.
Are you doing it on a smart contract? Are you putting in USDC and you're receiving some token that you guys have created? Like an ERC-20 token?
Yes, that's, you got it. The way he described it. If you want to say that a little louder so that everybody could hear it, but
Yeah,
that's.
so you put USDC into the smart contract, then you'll get the ERC token out of it. You have to hold it for 12 months. Then you can go to a decentralized exchange like SushiSwap, Uniswap, like any of those swaps, and swap it for whatever token you want.
With one caveat though, because these have to be traded on
T0.
broker dealers. Yeah.
T0, yeah. So we have, you can't go to SushiSwap. You have to use T0. And T0, so if you guys don't know what T0 is, I encourage you, if you take one thing away from tonight, is two things. Number one is visit marketspacecapital.com, of course. Secondly is to download the T0 app.
Are we
right?
recording this?
T0.
Because T0 will be sponsoring our
I know, our next event. So if you guys don't know about T0, T0 is basically, if I was to say, you know, they're valued somewhere between Coinbase and Robinhood. They're the only SEC FINRA approved secondary exchange. Yeah, but their newest iteration of their app, there you go. So the newest iteration, alternative trading system, an ATS. So the newest iteration of their app is you'll have the ability to buy stocks, to buy cryptos, to buy NFTs, and then to buy digital-backed security tokens and like ATS in an alternative trading system like real estate-backed tokens. So imagine one app that you can do all of that.
Yeah. Oh.
Hey, calm down over
Yeah, we
there,
do.
all right?
Your white bias over there. So number one, are you using a DAO in any cases instrument issued tokens?
No.
No.
Number two,
Could.
when does that fungible become a non-fungible? Are you using 1155 as a standard to do the conversion? Because it has a unique value at the end of its construction. When you completely liquidate, it has a unique value, so it's no longer fungible, right? It has a non-fungible, it's not fungible.
Correct. Well, you guys want to take a shot at answering that?
I'm not.
Okay, well, I'll
So,
tell
Al,
you.
he's
I'll
the
tell you this.
tokenization guy.
So the way that
So,
we have
we're
to,
learning up here as well.
The way we have to attribute the value of the actual token is through quarterly appraisals. Okay, so right now, again, as we build the property and we go through construction and we achieve certain milestones, as I mentioned earlier, the value of your token is increasing. Ultimately, the value of your token is tied to the net operating income of the property. So if the property is making a certain amount of money, and again, on a quarterly basis now, so again, think of it as an IPO, right? In a public offering, you're essentially looking at the financials and how the company is performing. Almost the same identical use case here. But in this case, again, just look at Dallas. Dallas, the cost of materials, and you know we know this for a fact, right? 17%, it's increased, right? Rents have gone up by 24%. Okay, so you see the value of this token, of the land, of the real estate that we're doing is increasing. And so you're essentially participating in that, and that's validated on a quarterly basis by the appraisal.
It will be under continuous public ownership, or is that what you're saying?
Correct.
No liquidity event where there'll be one owner at the end of it.
Correct.
Supply side.
Yes.
And I want to hit the NFT, non-fungible real quick. So what we're talking about are fungible, you know, LP tokens. There is something that's different. That's an NFT. You know, you could have
have real estate in that it is not fungible if the token is, let's say, a full single-family home. That's a little bit different. There's also some different regulatory.
Yeah, we just saw a
issues.
single-family home that got sold as in Miami by Propi, right? Propi, and they basically did exactly that. And I know you have, again, I think these are really good questions. But right now, just understand we're in the wild west of this, right? Like nobody.
Yeah.
And it's. Yeah. No, and I totally understand. I'd
Yeah.
love to. I'll give you my business card and happy to share some information with you because we're all learning together ultimately, right? And the purpose of us doing this Myra Park project, which is the Myra token, it's going to start being traded on the T0 platform beginning March 3rd. So I encourage you all, of course, to check it out. But that Myra token, again, we're going through the process of learning all of this in terms of the implications to the market, how we're going to see the price fluctuate, the amount of investors. We have 69 investors right now out of $7 million of liquidity at an average investment amount around $150,000. So imagine we're going through, and out of those, I'll tell you, there's so many that don't even care, right? Like right now, 82% we've been able to convert to T0 accounts so that we can issue the tokens and put them in their account. The rest don't even care. They actually told me, they're like, hey, I don't really want to do this. I was just making this real estate investment, and I just want to, normal, traditional style. And we're like, look, this is going to offer you liquidity, and they just didn't care. So there's always going to be those investors as well, right? And 82% is a very high number. According to T0, it's like one of the best, right? So imagine that out of all of these that are actually being traded, you're getting half of those people that don't even care to take advantage of this technology.
I think Brian in the background has a question. Yeah.
So back to Myra, your syndication, your offering.
Yes, sir.
Right? With a PPM.
Yep. No, we raised traditional funds at a minimum of $50,000. Then we went back and tokenized it.
Is it only accredited investors? How does it work with the SEC? Can you talk to that, please?
The initial investment is only accredited investors. Of course, all of our investments, we do public marketing. We're on Facebook, LinkedIn, etc. And so all of our investments require third-party accredited investor verification. And so all of those original investors, they are accredited. But all of the people in the future, they don't have to necessarily be accredited, but they do have to go through KYC. And all of that is handled through the T0 platform. None of that is being done on like the market-based capital platform.
So here's a question, and since I'm going to just skip all of you in line who've been waiting, I'm sorry. What is the percentage, it's like a Reg D, is it a Reg D securities offering? What is the percentage of non-accredited investors that can participate in the secondary markets, or is it infinite?
Infinite. You don't have to be accredited to participate in that secondary market. Again, you're going through the KYC process through T0, and they're handling all of the SEC regulations there, but there's no limitations from our end.
Right here, yes, sir.
I just scratched.
Oh, okay.
How dare you, sir?
There's an
How
everybody.
dare you?
All right, thank you very much.
No, they do not. Good question.
Was that a decision, or you have to do that?
Do the secondary buyers get to participate in the depreciation?
It's a great question, actually.
Okay, so for those of you that don't know what depreciation, and this is different from multifamily assets as opposed to single-family residences, for each property that we acquire or we renovate, we perform what is known as a detailed cost segregation study. That cost segregation study breaks down the different components of the renovation or the construction into different tax categories. So for example, flooring, lighting, that might hit your 10-year category. Toilet fixtures might be 7 years. Paint might be 5 years, etc., right? So the point is that the existing tax laws allow us to depreciate 100% of that in the first year alone. So if you made an investment with us for $100,000, then we could potentially give you a K1 that year from that cost seg study that in the form of 64, our last project got like 64% on the cost seg. So I would give you a K1 on your $100,000 investment showing that you had a loss of $64,000 that you can then apply towards other ordinary passive income on your taxes. Now, yeah. So to your point, K1s are distributed, but the maximum depreciation, to answer your question, is usually done in that first, second year because and to be honest, our whole period is 5 years. So we acquire the asset, we get rid of all the bad tenants, we invest in renovating it, we bump up the rents modestly, we refinance, and then we cash flow, and then we're out of the deal. right? It's not necessarily a long-term hold. At least that's not what we're selling to our investors. I hope that answers your question.
Yes, sir.
Two questions. One is, I kind of think I know the answer based on this clearinghouse thing, but you don't have any way of regulating or controlling who the people can sell in that secondary market. Like, if I buy a token and
No.
I want to sell it, you don't have any way.
I mean, if you're a approved user on that platform, you have the ability to buy and share. We don't have any control of that, and that's a 24/7 market, right? It doesn't sleep, so you can literally come in at any time.
The second question I have is, so when the government, figures out the difference asset token, how do they screw this up?
That's a great.
Great question. I mean, so
I'm not gonna repeat that question.
we looked at, kind of a SWOT analysis, right, of what the strengths, weaknesses, opportunities, and threats are when it would come to, the tokenization of real estate. So one of the biggest opportunities we saw was this market. In 2019, there was about $1 billion in this market of digital-backed security tokens, right? In 2021, that was $1.9 billion. Okay, so we see by 2025, that is supposed to hit $5 billion. So this is happening right now. Like, we are living in the time where the proliferation of blockchain into real estate is going to happen, and it's happening right in front of our eyes, right? So we see that as one of the biggest benefits, is that it opens up the universe of investors for our projects, right? So we're not only just looking at those, accredited high net worth investors. It's essentially opening up that universe there. Secondly, then we started looking at the threats, and to get back to your question, sir, one of the threats is obviously regulation. Now, I will tell you, as a private equity real estate firm, we go above and beyond right now in terms of making sure that our investors are accredited, them going through third-party accreditation. So there's an attorney or a tax advisor that's reviewing these financials, and they're providing a letter saying that they know the risk and that they can invest in this real estate. So we're already doing a lot of the stuff. Now, when you're on the T0 marketplace, you don't have to do any of that. So we're going above and beyond right now for regulatory authorities, right? That's kind of hard to put those two words together. But nevertheless, we know that we currently are kind of doing, more than they asked for. So we welcome regulations, because I feel like it's going to take out the bad actors and those people who are trying to scam people. It takes those, and you hear those stories all the time. So I feel like it removes them, and that increased regulation actually will help our industry.
Yeah, I agree completely. That's definitely needed. You need to get rid of the Wild West, so to speak, and I think some amount of that regulation is certainly warranted.
Yeah.
Yes, sir. Yes.
If
Where the tokens themselves can gain, shows the market value, trade at a discount or a premium to the underlying law.
Yes, 100%, right? I mean, you're looking, you want to tell them a little bit about St. Regis? Sorry.
So is there a scenario in which the tokens appreciate or depreciate based upon market sentiment or whatever in the secondary market, regardless of, or maybe not regardless of, but slightly independent of the traditional appreciation or the traditional appraisal? Is that fair? Yeah. I mean, so when you go on the T0 day, I bought like one share of the St. Regis when I went on there, and a very small modest amount, but you can see it's a order book instead of what's the other Brian. There's no market maker, it's an order book. But eventually, when there's enough liquidity, enough volume, then there will be market makers. This will be sort of like a public market liquidity for private equity. And I think what Brian said earlier about this isn't just real estate, this is any private equity, a business, anything that's not traded on public markets, you can do this with.
Yeah, if I could comment real quick on the tokenization and owning a bunch of real estate and seeing why it's valuable. A lot of people have been talking about trading the tokens back and forth. If you're a passive investor, I've invested in passive deals. I'm not going to want to sell those tokens. I'm going to want to invest into that project and have the collateral. Now that it's been tokenized, my shares have now been tokenized, so I have collateral. Then I can go and take it to a bank and have a loan drawn against that to be able to become liquid. I don't want to sell my tokens on the secondary market. I would be out of the deal. So I want to keep my value in the deal while maintaining my liquidity, going to the bank with my collateral, getting the loan to invest in another deal. And then I can do it again, and then I can do it again, and then I can do it again. And then all of a sudden, you've literally changed real estate from this illiquid asset, but you never have to sell any of them. You sell when the deal is done, or they refinance and you maintain. You know, and I think that a lot of people are missing that aspect of it. That a lot of the investors today don't want to sell their shares in the deal, but they may have to get into another deal, or because they have liquidity for something else that they're doing. And that is where the real change happens, in my opinion, with tokenization and syndications. I think it happens first, 100% in syndications because of that. You know, not everybody has 100 or 200,000 to just put in for a 3 to 5 year period because there's a lot of unknowns, especially in the market. You have interest rates that are rising. Some people might not be able to refinance. So if I thought it was a 2-year hold turns into a 5-year hold, right now, all you can do is go into that syndication and you can talk to somebody and say, hey, can you give me some liquidity? And they will, or you go to the syndicator and they'll give you a discount. Neither one of those really work that well, depending on how much liquidity you need. You know, so that's, I think, what a lot of people are missing about this in that is that it gives you the collateral. You take it to a bank, you get a loan, you get your liquidity, you put it into another deal, and you ride the deal up. And that's what makes real estate great. So
Just to expand on that.
Yeah.
Let's say somebody's holding a bunch of Bitcoin that if they sold, they had a large capital gain they would have to realize. And I want to get into your deal, but all I've got is Bitcoin. I could go lend that get money, stake that Bitcoin, get money, buy into your deal.
100%.
Not have to pay capital gains. Now I start earning the distributions, and I own part of that property, token, and now I have all the benefits of that token as well. So that's what Yale's kind of describing.
Yeah.
And that's once you realize some of the capabilities that all the digitization and tokenization of assets brings, then
It's game over.
your mind just opens up.
So can you do that in DeFi? Like, I don't know enough about the T0 platform, but like, when I go to a bank.
Security.
Yeah.
You could, yeah. I just use bank for references today. I think it will become to where you can just take your tokens and it's a few clicks of a button like a BlockFi loan against your Bitcoin today. And I think that's like the true value of.
You're seeing
yeah.
a lot of this, the cross-chain, trades and
I've bought real
exchanges
estate.
and
I bought real estate with taking loans against my Bitcoin.
when there's
So,
a need
today.
out there,
Yeah.
when there's a need out there, there'll be somebody to fill that.
Yeah, it's
that
a lot
void.
easier than getting a real estate loan.
A
lot easier. Yeah.
Some of our panelists have a hard stop. So 2 things. A few of the panelists will remain behind and probably have further questions. You can talk to them individually. And the other thing is, let's just give the gentleman here a round of applause.
Very good.
Yeah. Good job, Colin.
So go ahead and then really quick, just say where they can follow you on social media and all that stuff, where they
Sure.
can find you on the internet.
Sure. Well, first and foremost, thank you again to the Texas Blockchain Council for inviting us here. I mean, I know you guys are hosting some quality programs, and this just is evidence of that. So look forward to participating in future events with you as well, Lee. But yes, for anyone, unfortunately, I can't stick around, but my email address is my first name, Sohail, Sohail, at marketspacecapital.com. I'm also on LinkedIn. I'm very responsive, so feel free to reach out. If you're ever in the Houston area, feel free to come by our office. I'll take you out to lunch, and we can talk a little bit about blockchain and real estate. Sound good? Thank you.
I'm not on social media very much, but I'm on LinkedIn. You can search me by name, Brian Shepler, and also brian@shepler.com is my email address.
Yeah, I'm on all social media. Yale Hamrick is for everything. So just type in Yale Hamrick if you want to find me. YaleWHamrick@gmail.com is my email address. And yeah. Hamrick, Hamrick.
I didn't mean to pressure you guys to give out your email addresses publicly.
That's all right. If you want to learn about Bitcoin, follow me on Twitter.
So I'm getting a signal like we're recording. What's it? Yes, you can access the recording later. For more information on that, email me or Ryan. YouTube. Oh, subscribe to our YouTube channel. That's a great point. And have a great night.
Thank you, guys.
Thanks for coming. Thank you. Thanks for having me. Good.